There is a risk here that we rerun 98.99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow off kind of next 9 months or so.
The world might be heading toward a big market rally, not a crisis, says top investor Raoul Pal. Just think, what if there's peace in Ukraine? A big deal between the US, Saudi Arabia, and Iran, or better cooperation with China? If even two of these things happen, the big fears holding the markets back could disappear. With inflation going down and fear fading, Raoul believes we might see a sharp jump in stocks and crypto. Not because of strong business growth, but because people rush back in once they feel it's safe. Right now, many investors are still unsure, but money is quietly flowing back into the system. That could lead to a fast and powerful move up. In this video, we break down Raoul Pal's latest thoughts and why the next 9 months could feel like the wild post-COVID rally all over again. Make sure to like, subscribe, and hit the bell so you never miss an update.
So, what I've done is built that framework of how crypto is just a macro asset. And it took a long time for people to believe that. They thought it's something different, it's something unique. It's a macro asset. So you apply the same things that I've always used, which is liquidity, business cycle, all that stuff, plus a bit of technicals and sentiment. There's no voodoo here. It's pretty straightforward as an asset. It's just more volatile. So it's harder to deal with. But you were right. What I was seeing was like the liquidity indicators like Global M2 had stabilized and started going up. It leads Bitcoin. Bitcoin was following it almost perfectly. So I was starting to look for the bottom. Then I start looking at stuff like, okay, where's sentiment on NASDAQ? Because it's tech stock, same thing. It was in the gutter.
Right.
Sentiment was the worst I had seen since COVID. That was across the board, across everything. Even hedge fund long short, everybody was max bearish. And I'm looking at liquidity. It's going up. I'm seeing the market getting fearful over a narrative. And I'm like, well, what is the likely outcome here? Are they going to have 150%, a trillion% tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to things could only be better from here. So for me, it was like a no-brainer of an opportunity, both in tech stocks and in crypto. And so going forwards now, normally speaking, this is the period, my framework is about, them rolling the debt and having to provide liquidity to do so. And so what we've got is a lot of forward-looking liquidity coming out of whether it's the weakness of the dollar, whether it's other countries using their balance sheets, a number of different mechanisms. And all of that to me is suggesting that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ was going to be a V-shaped recovery. And my God, it was a V-shaped recovery. And people are still underweight and short. It's a hell of a setup. We overlaid the chart of 1997, the Asian crisis, was a short, sharp shock, versus now it's almost identical. The 4-month period leading up to it, 4 or 5 months leading up to it. And that was a V-shaped recovery as well, because everybody was caught off sides because they thought the world was going to end. Liquidity came into the system. It was via the Fed that time cutting rates and all the other central banks. And the market just went up in a straight line for the next 2 years. There is a risk here that we rerun 98.99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow-off kind of next 9 months or so. The last Trump cycle in 2017, we had the same thing. The market corrected in the beginning because everyone's fearing tariffs and the same narrative. The Fed were raising rates and doing the balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine.
While most headlines focus on inflation and global tensions, Raoul Pal sees a very different picture. He believes crypto isn't separate from the larger financial world. It moves with global liquidity, investor sentiment, and the business cycle. And right now, those forces are shifting in a big way. Money supply M2 is rising again, which has often signaled gains for Bitcoin and other risk assets. At the same time, investors are still cautious, even as prices recover. That's created what Pal calls a no-brainer setup. Liquidity is increasing quietly, central banks are stepping in, and the dollar is weakening. Pal compares today's moment to the surprise rebound after the 1998 Asian financial crisis, which sparked a major 2-year rally. He says this isn't about the Fed cutting rates. Just the fact that they've stopped tightening is enough. With macro fears fading, we could be in the early stages of a major run in both crypto and stocks, lasting well into next year.
What do you think about gold here, Raoul?
So I came up with something, it was only last month in Global Macro Investor that kind of shocked me, hadn't figured out, is that there is a set of dominoes that happen in markets. Financial conditions lead everything. For financial conditions, we use the dollar, rates, and oil. Right, the 3 big financial conditions thing. What we found is that leads like the ISM and other stuff by about 9 months. And it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and NASDAQ, and it leads it by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. I found out, I was like, what's going on with gold? I put it against against financial conditions. It reacts in real time to financial conditions.
Wow.
I'm like, holy shit, why didn't I figure this out before?
Of all trading securities, right?
Of all the things, well, because it's a pure currency asset, right? It's the pure thing. And so the moment financial conditions ease, gold moves. And so it's leading everything else. Which was, we were kind of thinking, is it leading or is it doing something weird? Is it trying to price in some catastrophic risk? No, it was just pricing in the fall in the dollar, the fall, rates didn't really fall a great deal, but the fall in oil.
And I'd throw on, the visible death of fiat currency as, Western nations drive their deficits and their borrowing levels to absurdity. It seems like that's something gold was reacting to on the way up, right?
Well, that's what the financial conditions are in the end.
Yeah.
It's the debasement of currency. It's the whole thing is the debasement of currency by excess liquidity being pumped into markets by any mechanism possible. At first, they used the balance sheet. Then we all figured that out and called that money printing. So then they did this Fed net liquidity trick, which was the balance sheet plus the Treasury General account and the reverse repo. Yeah. Then we figured that out. And then they moved to total global liquidity, which is including M2, which is stuff it on the banks' balance sheets. So force the banks to buy bonds. That's the game.
Raoul Pal believes we're on the edge of a major financial shift, one that looks like the past, but is moving much faster. Big players like Middle Eastern wealth funds, U.S. pensions, and institutional banks are starting to quietly pour money into crypto and stocks. What's changed? Clearer U.S. regulations are finally giving them the green light. Many still don't fully understand crypto. Some fear the volatility, others can't fit it into old models. But Pal says this is just like past market revolutions. Commodities, gold ETFs, where early adopters gained the edge. Now it's crypto's turn, powered by strong macro tailwinds. At the core of Pal's view is a data-driven model. The dollar, oil, and rates shape conditions. liquidity follows, and risk assets respond. Bitcoin lags liquidity by about 3 months, while gold reacts almost instantly. As governments run massive deficits and central banks manage liquidity behind the scenes, markets are adjusting to deep structural changes, not just short-term noise. This isn't hype, it's the start of a broader shift. Liquidity is rising, investors are still cautious, and positioning is light. History shows that's when markets move fast. The only question now is, are you ready, or will you be left watching from the sidelines? If you found this helpful, like, subscribe, and let us know. Are we at the start of the next bull run?